The Forex market is where currencies are traded. It's the largest and most liquid financial market globally. Traders buy and sell currencies, aiming to profit from price fluctuations. In Forex trading, a lot is the standardized unit of currency traded. The standard lot size is 100,000 units of currency. There are also mini lots, which are 10,000 units, and micro lots, which are 1,000 units. Lot size determines the value of each pip, or point in price movement. A larger lot size means greater profit or loss potential for every pip change. Traders choose lot sizes based on their account balance, risk tolerance, and trading strategy. Understanding lot sizes is crucial for managing risk and calculating potential profits and losses. Leverage allows traders to control larger positions with a smaller amount of capital. It's essentially a loan from the broker, magnifying potential profits and losses. For example, with 1-to-100 leverage, a $10 account can control a $1,000 position. While leverage amplifies potential gains, it also magnifies potential losses. A small market move against your position can lead to significant losses, even exceeding your initial investment. Leverage is a powerful tool, but it should be used with caution and a thorough understanding of the risks involved. It's crucial to choose a leverage level that aligns with your risk tolerance and trading strategy. Let's consider a few scenarios with a $10 Forex account and varying leverage levels. Scenario 1: 1-to-1,000 leverage, 0.01 lot size. With an account balance of $10 and leverage of 1-to-1,000, the lot size would be 0.01 or 1,000 units of currency. In this case, a 10 pip movement in your favor would result in a $1 profit, as 10 pips times 0.10 pip value equals $1. However, a 10 pip move against you would lead to a $1 loss, wiping out 10% of your account. Scenario 2: 1-to-500 leverage, 0.005 lot size. Here, with an account balance of $10 and leverage of 1-to-500, the lot size would be 0.005 or 500 units of currency. With this setup, a 10 pip move in your favor would yield a 50-cent profit. Conversely, a 10 pip move against you would result in a 50-cent loss. These examples highlight the impact of leverage and lot size on potential profits and losses. It's crucial to understand that even small lot sizes can lead to significant gains or losses, especially with high leverage. Section 4. Risks involved: high stakes, small account. Trading with a $10 account carries significant risks due to the limited capital and the potential for amplified losses through leverage. One major risk is the high probability of margin calls. A margin call occurs when your account balance falls below the required margin to maintain open positions. With a small account, even a minor market fluctuation can trigger a margin call, leading to forced liquidation of your trades. Another risk is overtrading. The temptation to trade excessively to grow the small account quickly can lead to poor decision-making and further losses. It's crucial to approach trading with a small account with extreme caution, understanding that preserving capital is paramount. Section 5. Risk management: protecting your $10 investment. Effective risk management is paramount when trading with a small account. Setting stop-loss orders is crucial for limiting potential losses on each trade. A stop-loss order automatically closes your trade when the price reaches a predetermined level. Another essential risk management technique is determining your risk per trade. It's advisable to risk no more than 1-to 2% of your account balance on any single trade. With a $10 account, this translates to risking a maximum of 10 to 20 cents per trade. Diversifying your trades across different currency pairs can also mitigate risk. However, with a small account, it's essential to avoid over-diversification, which can dilute your focus and potentially lead to losses. Section 6. Conclusion: trading Forex on a shoestring budget. While it's technically possible to trade Forex with a $10 account, it's not recommended for beginners or those with limited risk tolerance. The high leverage required and the potential for significant losses make it a high-risk endeavor. However, it can serve as a learning experience to understand the mechanics of Forex trading and practice risk management techniques. If you choose to trade with a small account, prioritize capital preservation and focus on slow, steady growth. Remember that Forex trading is a marathon, not a sprint. Patience, discipline, and a solid trading plan are crucial for success in the long run.